During FY19, Garware High-Tech Films, which was then known as Garware Polyester, was generating revenue of rupees 950 crores. Its operating profit margin was around 13% and the business was generating a return on capital of roughly 9%. The company manufactures several types of polyester films. Move forward 6 years to FY25, the picture looks substantially different. Revenue had increased to more than rupees 2,100 crores. Operating profit margin was around 20% and the business was generating return on capital of more than 24%. Further, the gross debt had fallen to zero and the company reported rupees 650 crores in excess cash. So the question is, how did a polyester film manufacturer improve its margin and ROC so substantially, and is that improvement likely to survive over a long period? What is the investing concept attached to this case study and what are the lessons that we can learn? Going back to FY19, Garware already possessed manufacturing competency for polyester films. A large part of its revenue came from industrial films like packaging films and lamination films. The economics of these types of films are largely influenced by the basic characteristics of any commodity product, meaning the customers provide the specifications for the product and there are several manufacturers capable of producing a very similar product. So customers can ask multiple suppliers for quotations and then compare them largely on price, delivery time and credit terms. This characteristic does two things with the manufacturers. Firstly, the selling price of the product is not determined by the manufacturer anymore, but by the total demand and total supply scenario in the market. When demands exceed supply, margins improve, and when supply exceeds demand, margins fall. This is why a commodity manufacturer often struggles to earn consistently high margin. And secondly, manufacturers need to hold huge inventory for the timely delivery and need to work with high credit terms. This makes the working capital of the business high. Because of these two things, commodity-like manufacturers struggle to make consistently high returns. And this is what was happening with the Garware before 2019. But the question is, what the company changed such that the ROC of the business increased to 24% in FY25? Well, the answer to that question can be explained in three different points. Point number one. Somewhere between 2018 and 2019, companies started accelerating away from the commodity-like products and moved towards value-added products. Company developed new products like paint protection films and sun control films. Let's understand briefly about these films. Paint protection films are transparent films which act as a physical shield against scratches and UV rays on the outer of the automobile. Sun control films are thin multi-layered laminates applied to the inside of the glass window to reduce heat and block UV rays. In economic terms, company tried to differentiate its products. This shift changed the basis of competition. The company is no longer competing based on the price, it is competing based on the performance and reliability of the product. So the price of product is now less influenced by the industry's demand supply scenario but more by the product performance and customer value. And the result of this change is clearly visible in the revenue growth of the business. Revenue grew from rupees 950 crores in FY19 to over 2,100 crores in FY25, which is the growth of 14% CAGR for 6 years. Also, the operating margin of the business increased from 9% in FY19 to 20% in FY25. Coming to point number 2. The new product that the company developed could not be manufactured on the old production lines without changes. The old production lines were designed to maximize the volume produced, machine speed and low conversion cost per kg. In other words, it was designed to optimize the manufacturing of commodity like films. But the manufacturing of value added films requires a different set of variables to produce them, such as consistency in production, quality control of production and ability to manufacture multiple grades. So during FY20, company shut 2 lines for upgrades and modified them so that they could manufacture a wide variety of specialty films with more reliability and consistent quality. Later, company also added downstream processing facilities. This change meant that more of the factory's time could be used for products earning higher value and higher margins. Then, as the demand for the products increased, fixed costs associated with the upgraded and dedicated facilities were spread across larger output. In other words, the fixed asset turnover of the company increased. And lastly, point number 3. Specialty films are valuable only if they are installed correctly on the vehicle. A roll of paint protection film may be of excellent quality, but it is valuable to customers only if it has been cut, stretched and applied to the vehicle correctly. This makes the installation an inseparable part of the product. So, unlike industrial films where the company has just to test the specifications and then dispatch to the customers, specialty films require clear installation instructions. So, company started conducting structured training programs to teach applicators how to handle, cut and install these films. The training was conducted to improve the installation quality. Further, company attempted to organize this downstream network through Garware application studios. The independent detailing business would invest in the physical studio and equipment, while Garware would provide them the products and training services. This made the business of the company a very asset-light model and allowed it to expand its services quickly. So, summarizing the above points, the value-added products increased the margin of the business, increased the capital turnover and gave the company a room for quick growth. By consistently working on these changes, company increased the contribution of value-added products from less than 50% in FY19 to over 90% in FY25. These changes shifted the company from a commodity-like business to asset-light and high ROC business. And that is how a change in strategy and aligning its value chain accordingly improved the performance of Garware's business. Now, this case teaches us one main investing concept, and that is product mix migration as a driver of business quality improvement. If company changes what it manufactures and makes a differentiated product, a company can improve its business economics. To understand this, let's consider 2 manufacturing lines. First manufacturing line produces a standard material which the customers buy mainly looking at the price. Second manufacturing line produces a specialized product that will solve the customer's problem. Then the second line have higher propensity to generate more profit from similar worth of assets. But here is the critical point. A product mix becomes better only when it improves the economics after including all the additional cost and capital. A company can report higher margins while producing poor returns if the transformation requires excessive capital. This brings me to the 2 key lessons that we can learn. Lesson number 1. Never accept value addition as a business description. Investor needs to look at the evidences such as higher margins and higher returns on capital and customer qualification. Lesson number 2. A specialized product may require more variants and more inventory. This can increase the working capital requirement of the business. So even if the margins increase, but that extra profit is compensated by the higher additional capital, then there is no point. So the real test is whether the accounting profit is becoming the free cash flow after working capital and capex. Remember, a value added product did provide advantage to the Garware high-tech films. But we should also remember that these types of industries are cyclical and there will be temporary peak earnings in the business. So rising margin may come from the product mix, but it may also come from favorable industry conditions. So do check that. And that brings me to the end of this video. If this video provided value to you, please like this video and subscribe to this channel. Thank you so much for watching.